Hey, good afternoon. This is Rich Hellrick at Great Plains Annuity and Life Marketing. Happy cold Thursday. I've kind of lost track of time. It's been a busy month so far. Hey, I just want everybody that's on the webinar, appreciate you being here. Obviously, it's a big topic here because we got quite a few people on it. And what I want to talk today about is something that I've been on a mission here trying to convince a lot of the agents that I work with now for a long time, about how to, convert some of the upfront commissions we're making into trails. But one of the other things that I found out is that I work with a lot of RIAs and IARs, and the great thing about these guys that don't have the broker-dealer telling them what they can and can't sell, this makes a lot of sense in here. But one of the things that I think everybody looks at on their statements, especially if they have in a wrap account, are the fees. And right now with the markets going up, I don't think anybody gives a crap what they're paying in fee income to anybody as long as they're making good money. But there is a little hole here on the amount of fee income they're paying maybe on the fixed income side, especially when they're probably only netting 2.5%, maybe 3% on that fixed portion. So we're going to get into this here in a little bit. I'm going to try to talk to everybody about how to take, even if you're not an RIA or an IAR and you're a regular independent agent, you can still approach people that have money in the market and say, hey, how would you like for me to show you an alternative to having money in your fixed income portion and eliminate the fee that you're paying that broker. So it works both ways. So anyway, let's go to the next slide. And, let's look at why would the client be interested in this? Well, obviously, they can drop their management fees considerably. And from the first slide, 10%, depending upon the allocation that they have. But, it can go as high as 60% and even higher, depending upon how they're allocated. No market risk. That's always a good thing. It's an alternative to traditional fixed income options, bonds, 8 and 10, 12-year bonds, whatever you have them into. It's set maturities and all that stuff, so it's a great option to that. Always with everything we have, guarantee a principal plus annual index gains or locked fixed rates. Now, the reason why the fixed rate's important, and I should have said this at the very beginning, there is a new product coming and a slide at the very end of this that I can't wait to tell everybody on this about. It's literally going to change how you do business the next 2 or 3 years, I believe, and it's going to also have the ability to put a lot of money in your pocket and eliminate all these fees to boot. Everybody in here is just going to love it. The other thing about everything we're doing, you can defer taxes. If you don't need the income, why pay it? Defer the taxes to somebody else's generation or, offset it with a life policy, whatever you got to do. But, it's always a big thing. And the other thing is there's no long-term commitment to it. You got 5, 7, 10-year stuff. Nothing really any longer than that selling these days. So, yeah, very short time commitment with what we're doing. And then why would the RIA or IAR be interested in this, or even the regular independent rep? We're going to reduce the fees the client pays out of their pocket. It's a replacement or complement to traditional fixed options. The annual 1% commission paid by the company, not the client. So let's stop here. And we're going to get to that slide in a little bit. I mean, if you take everybody and throw them in the hopper, the average fee that advisors are being paid to manage money at 1%, that's the coveted number. They want to stay at 1%. Our approach keeps it at 1%, but you're going to get a lot of help from the carriers that they'll pay that fee, a big chunk of that fee, and not the client. And it doesn't reduce the principal from loss, resulting in lower fee income. And we all know what that means. I mean, if a client gets credited 4%, you're taking out 1/4 point every quarter when you take out your management fee. That comes right off the client's pocket. This one does not reduce the client's statement one bit. And the other reason why I'm going to tell you as a fiduciary, hey, it's the right thing for the client and the advisor. The advisor ought to get paid, but the client ought to, any way they can save money, I think it's a good deal. And, also, I think a lot of guys that understand where everything's heading to, like robo-investors and no mutual funds and everything else coming down the pike here. I mean, and as everybody gets more intranet savvy and internet savvy, I mean, man, they're going to be able to go in here and, I don't have to pay you 1%. Well, I'm paying my advisor with the professional management 1.4, and you're telling me T. Rowe Price can do it for 40 basis points? I mean, my point is, I think everybody down the road, not maybe today, but within the next 5 years, I think you're all going to have to sharpen a pencil to retain those clients. So anyway, and this does it. Let's just take a look at a $100,000 case example. 10-year rates, where did I get 4.9? The 4.9 is based off what the indexed annuity has been performing as of late. And in fact, last year we were getting 14s and 15s. So, hey, you know, you lump all that in over a 5 and 7 year contract with what the thing's averaged, there's where we get our 4.9. Now, on the last slide, I keep trying to go back to that. There's going to be a fixed income on income coming out of 4.65, I do believe. So even if you need to have something more guaranteed, that option is going to be available to you real quick here. Okay, so now we go over to 10-year rates. Now, I think I'm off. The 2.5 is based off what I deemed what were investment grade bonds and AAA. I can't go to junk. I mean, I got to stay in AA, AAA, because every insurance product is out there. It's insured by a state guarantee fund or backed by the assets of the company with set maturities. Bonds are not like that. You know, the corporate bonds backed by the strength of the company, and you know, obviously most of them are going to be there, but it is what it is, and you can't. So we got to stay at AAA and AA rated bonds. 2.5% is what the client would net. And let's just say it's gone up and you're getting 3. Even if it's a 3 and less than 1%, client's netting 2%, which would be $2,000 if I'm off a little bit on that number. But even $2,000, we're at $2,900. So in a nutshell, we're $2,900 on our fixed portion of that client's assets with no fee, and that 1% is never coming out of the client's pocket, yet the advisor is getting the same benefit of it. Okay, so that is where we're coming up with those numbers. The other thing, you know, to think about interest rate risk. With what we have no interest rate risk. The set maturity at least get the guy's principal and gains back. On bonds, you do have risk if you have to get out of it and sell early. Especially at death or anything like that. Taxable, none of ours is taxable. Taking income off the bonds, or even if you aren't taking income off the bonds in a portfolio, you're still going to get a 1099 on that income portion. So big differences there for the client. And then let's go out here and talk a little bit more, you know, how are the client fees reduced, and we're going to like get tick for tack. I'm basing this off a $1 million account, managed account A. Risk allocated, you guys come up with the equation that $500,000 ought to be in the market, and even under managed account B, still $500,000 is over in that market, and the guy is still charging the 1% fee off that. Fixed allocation the old way, $400,000 is what would be in fixed bonds of various maturities and paying out, you know, to the client. Ours is the same way, but we're going to basically use annuities to do it. $400,000 goes into managed account B, and you can see I moved the fixed allocation, the new portion of the $400,000 into that side and took it away from the old account. Left $100,000 liquid. Now, the old way for the RIA, IAR, they're charging the 1% fee, which I don't have whatever, if you're having a professional manager manage it over and above that. But what the broker's making is $10,000. Over here on our side of it, if we take the $400,000 and take the 1 point off the fixed allocation percentage, that client only paid $6,000 out of their account. So they're going to get hit, instead of $2,500 a quarter, they're only going to get hit $1,500 a quarter. And for the advisor, they still maintain that other $4,000 that looks like is gone. It's still being paid by the insurance company from their pocket and not the client. We're having very good luck with people buying into that concept. Okay, so let's go on down to the next slide there, Rob. You know, from our standpoint, you know, we've offered, and a lot of these products on the index side, there's a lot of products now that have the trail commission. Some of them have a moderate commission where they pay a 50 basis point trail, or you can go out here and not take any upfront and get a full 1% trail. The crazy part is, and the good part is that the 1% trail does not stop after the surrender. You buy a 5-year index, it'll continue to pay on years 8, 9, 10, 11, 12 on out if you leave the money with that carrier. And a lot of times you won't even have any new surrender charge, completely liquid. That's a good deal. and then you go back to that 4.9% potential return. I mean, it's like buying basically a 5% bond with no fee. It's a great way to go. It reduces the client's annual fee, and more importantly, if I'm the advisor, which I get all that, you protect your fee structure that everybody wants these days. Okay, and I'm basing this off of a short-term indexed annuity, and I added the other part, a guaranteed fixed annuity that credits gains annually, or if it's a compounded rate from a traditional fixed annuity. Traditional fixed annuities were not even probably considered in this component. A couple of reasons why is because they weren't paying trail, and then B, the other option is that, man, I'll be honest, the rates weren't there, 2.5% on a fixed. But I think the product I'm getting ready to show you guys, it's going to change that whole dynamic. Okay. Current product, I really like this product. One of my favorites. 7-year surrender charge, A- rated carrier. I think the cap may have just went up to 580. So the 4.9, okay, the 4.9 that I had in that contract, if you go in here and look at it, you got a cap in here of 580. That's where I'm getting a 4.9. But let's look at option 2 down there, that 45% participation rate, uncapped, no fee. Market's up 20%, my client makes 9. Market's up 30, I'm going to get 13.5. Market's up 5, I get 2.25. All I'm trying to say in here, I don't know what the markets do down the road, but a portion of that, a client would do real good. Now, the Croaky index, I do know this, and we have the proof that they came back from last year's renewals. The Croaky was kicking out 14 and 15%. No participation rate, that's what the actual client put in their pocket. So when I'm using the 4.9%, we're right on target with what that basically a 7-year corporate at 4.9 would kick out to the client. 2.5, if I'm completely wrong, good God, I can go out and buy the 2.5% fixed rate with no fee to the client and do what the what the managed account is right now paying. So either way, I've got the thing beat. You protect your fee, you still get paid. The client doesn't pay the fee, and everybody, it's a win-win deal across the board. And at least it deserves a look at, if you got 400,000 in there, for God's sake, put a couple hundred in something like this, and drop the fee and see how it works. And I think you'd be very happy with it. So, as a fiduciary, I go back to this. That's what we're kicking around. I've seen so many ads about I'm a fiduciary, I do the right thing. You know what? If you're a Ford salesman, you got to, if you're only selling Fords, are you doing the right thing by not showing the Chevy? And that's what I'm going to tell you here. I think you owe it to your client, you owe it to yourself to take a look at a concept like this and try to find out where I'm wrong on a particular strategy like this. But I think as a fiduciary, you owe it to yourself, and you definitely owe it to the client to drop that fee and do the right thing. So anyway, let's go on to that next slide, Rob. This is the slide I want to talk about, a new idea that's coming out for you guys that are on here. It is not here yet, but we've been working on this brainchild now for quite a while, and it's really, really close. But we're going to have a fixed MIGA rate that changes everything. Look at the rate here, 3.7% guaranteed for 5 years. 3.7. Your managed accounts, I know, charging the client 1% are not doing 3.7. Guarantee it. If they are, you got a hell of a lot more risk than what something's guaranteed is. I know that. Moderate commission. Right now I'm thinking it'll probably come out around a 2% commission plus a 40 basis point trail for the life of the policy. So think about something real quick. 2%, and then years 2, 3, 4, and 5 at $1.60. And my 2, it's a 5-year MIGA rate of 3.6%. If I go out here and email that out and send that out to all advisors, the banks, the broker dealers, everybody out there, I don't have enough people in here to answer the phone from people coming in here. If you want to guarantee that trail for a longer period, 415, 10-year guarantee option as well. Again, I think it'll be around a 210 first-year rate or 210 commission with a 40 basis point trail. And all I'm going to ask in here, what the heck is a AAA rated 10-year corporate at? Because that's what you got to compare it to, because we're guaranteed and insured. I don't think it's anywhere near 415. 4.15%. And I know from my broker days, as a transaction broker, it sure as hell ain't paying you 5.7% in commission. Okay, just something to think about. Now, the other thing I think, going back to the income, any of these guys who want to put any income in there, they need income, you go, Rich, but they don't pay income. blah, blah, blah. Hey, looky here, a simple interest rate product, 6.5 year one with a 4.65 guaranteed rate, 2 through 10. It's simple interest, so that means you're going to want to peel the income off of it. Great income generator. Here's the big thing: is no fee to generate the income. Income riders, if anybody's doing income riders, we all know you're paying 85 to $1.25 for an income rider fee. No income fee on this at all. The other thing is, on income riders, your $100,000 you put in there, at the end of 10 years, you got a 30% reduction in your principal amount. 20 years, your $100,000 is worth about 35. Take this contract out, the beneficiary gets put 100 in there, they're going to get 100 back, and the client would have gotten $4,650 a year till year 10. And then I'll come back to both of them, what happens at the end of the 10th year. Principal stays intact. Again, moderate commission with a 40 basis point trail. If you go in here and if it's a 210 rate or 210 commission with a 40 basis point trail, you're going to be at about a 5.8% commission on that product. Again, I go back, I don't know what AAA rated corporate pays that kind of commission, and I sure as hell don't know which one pays $4.65 to the client. So anyway, that's the deal. Other great thing about these products is that at the end of the term, if you go in here and re-up for another 5, 7, or 10-year period, you pay the commission again, and your trail continues. I'm just telling you, this product here is going to change and revolutionize everything that everybody's doing out there on the RA side, on the IAR side, on the independent agent channel. It's going to change everything. And I hope you give me a phone call and want to know more about it when we get closer to it. So anyway, the last slide in here, Robbie. Call Great Plains. Call me on the new product. If you want to talk about it, I'm happy to tell you more. But you heard most of the gist right there. But if you have an interest in learning more what I'm doing to reduce those trail fee incomes and find out more about the index products that I really like, give me a phone call. Call your rep up here, and we'll get you hooked up. And let's get those fees reduced. It's a fiduciary responsibility, and we all do the right thing for our people, and you can do the right thing here. Thanks a lot, and I'll talk to you next week.